And we appreciate you all coming out to hear about a thrilling topic in regards to insurance. Definitely a hot topic as everyone's premiums seem to keep skyrocketing and deductibles seem to be skyrocketing, and all of the reimbursements that the medical community gets seems to be going down. There seems to be a weird trend in that regard. Well, anyway, hopefully our speaker today can make a little bit of sense to that. Today's topic, how do you find the best plan and what does it mean for doctors in regards to all of the insurance stuff? Craig Rodrigue is here. He's got over 20 years of experience with formulating and implementing plans for life insurance, healthcare coverage, and disability protection. He's got a laundry list of accolades that he'll kind of go over into his presentation, so I won't take up more time to do that here now. But he is a UCF graduate, go Knights, and he operates his own business now for over 25 years, giving him great expertise. He lives here in Southeast Orlando with his wife and 3 sons. So a warm welcome for Craig Rodrigue.
Thank you very much. Good morning. Thank you for having me. I'm so excited to be here. I think your group is awesome, and so I've been happy to be around for the last few months. How did I get here and why am I talking to you about healthcare reform? And I think that's a valid question. About the time the president was elected, I was the political involvement chair for the National Association of Insurance and Financial Advisors. What that means in English is it was my job to study the law since before it was passed and then communicate back to the agents how it was going to affect us, how it was going to affect our clients. I've testified for the Florida Department of Insurance on numerous occasions about the effects of healthcare reform on us as citizens. I've been to Tallahassee and DC, and I've met with senators and congressmen. I've done national conferences. I've done conferences for congressmen in other states, Chicago, et cetera. I've done things for AMAC, the Association of Mature American Citizens. So I have a long history in healthcare reform, and I've been doing this since before the law was passed. And I think I have a simple task of just explaining what happened with the 15,000 pages and what we can expect coming forward. And so that's really a little bit about who I am and what I'm all about. I think we could start right here. This is Nancy DePearl, the White House czar on healthcare reform, and this is April of 2009, approximately 1 year before the healthcare law is passed. And it says, a public plan is something that's sponsored by the government, therefore has very low or almost non-existent administrative cost compared to others. It doesn't have the need to have brokers out selling it. That gave me the warm and fuzzies. It wouldn't have the need to have a lot of cost and profits the way that a private plan would, so it has that advantage. What I have for you is, this is the flow chart of your low overhead, non-administrative expense healthcare plan. These are governmental agencies either new or expanded as a result of healthcare reform. So healthcare reform, a lot of people don't realize, of the 2,700 pages, over 700 pages were new penalties, taxes, and fines. It's one of the largest tax bills passed in American history. What was the goal of the healthcare law? The president said that he was going to cover everybody. How was he going to cover you? He's really going to cover you in one of 2 ways. The first way is each and every one of us has a mandate to own health insurance or pay a penalty. So regardless of whether our employer offers us coverage, doesn't offer us coverage, pays for some of it, doesn't pay for some of it, all of us have a mandate. The other way he was going to cover us is there's a mandate for large employers, employers with more than 51 eligible employees, to offer coverage or pay a penalty. Then really, the way we were getting covered was we're all mandated to go out and buy it. Now, the healthcare law did some good things, and some of the good things it did is all plans are guaranteed issue, there's no more pre-existing medical conditions, everything has to meet the 10 essential health benefits, but to do that, we had to have the carrot and the stick. What's that famous old saying, the beatings will continue until morale improves? We have the carrot and the stick, we want guaranteed issue, no pre-ex. What's the stick? Well, the stick is on the individual side, people can only enroll during the open enrollment period. So actually, if you called me today and said, Craig, I want to buy health insurance, the answer is actually, I'm sorry, you can't have any health insurance. You have to wait until the open enrollment, which starts November 1st. That happens to be Tuesday and runs through January 31st. So during that period of time is when everyone who owns an individual medical plan has a right to change their plan or buy coverage. Everybody's heard about the penalties. A little bit of history about that. 2014, the penalty was $95 per adult, half that for a child, or 1% of your income, whichever was greater. That led a lot of people to say, I'm not going to buy insurance, I'm just going to pay the $95 to later that year end up at their accountant saying, what do you mean I owe $1,500? I thought it was going to be $95, because they didn't catch the 1% of your income. This year, if you didn't own health insurance, the penalty is actually $695 per adult, half that for a child, or 2.5% of your income, whichever is greater. And that's actually going to continue to increase by inflation, and I haven't been able to find anywhere yet what they're saying the penalty is going to be for next year. There are subsidies available on an exchange to help people buy health insurance. I always like to do this because I think a lot of people hear things but they don't understand how stuff works. So let's talk about how it actually works. Across the top is the number of people in your family. Subsidies are available between 100% and 400% of federal poverty level. What's that mean for me? If I'm single, it means I can earn between $11,800 up to over $47,000 a year and still qualify for a tax credit on the exchange to buy insurance. Family of four can earn between $24,000 over $97,000 a year. This is not the poor that so many of us thought this law was dealing with. The median household income in the state of Florida is about $44,000 a year, meaning 65% of us qualify for tax credits on the exchange. Then how would it work? My buddy David, he's a family of four, and he made $48,000 last year. That puts him at 200% of federal poverty level. The reason why that matters is, depending on the percent of poverty level you're at, that determines what percent of your income you pay for your health insurance. So if you're at 133% of poverty level, you pay 3% of your income, 250 pays 8. Then what happened to my buddy David? David's at 200% of federal poverty level. He's going to pay 6.3% of his income for his health insurance. Probably can't see the bottom because of the rail, but $48,600 times 6.3 divided by 12, David can insure his entire family for $255 a month. When I'm asked if anybody benefits from health care reform, absolutely. David benefits big time. It's a huge win for him. But what's the $5 question? Yeah, Craig, but what kind of coverage does he get? There's 4 kinds of plans available on the exchange: bronze, silver, gold, platinum. The subsidy is actually based on a silver level plan. To give you some perspective on that, I've got plans $10 for the doctor, $20 to see the specialist, $2,700 deductible, and includes maternity and mental health and prescription coverage and everything else. So pretty good coverage. What's going to happen is I'm going to enter David, his wife, his kids. I come back to David and I say, your plan's going to cost $1,254 a month. But I told you David was going to pay $254 a month. That means David got a $1,000 subsidy to help him buy health insurance. Once we've established the $1,000, David can move up or down this chart however he wants. So if David said, hey Craig, I can't afford $254 a month, what if I went down to the bronze plan? Bronze plan's $1,050. David has a $1,000 subsidy. He just pays $50 to insure his whole family. Oh, Craig, I want great coverage. What if I went up to the gold plan? Gold plan's $1,400 a month. He's got a $1,000 subsidy. He pays $400 to insure his whole family. Then what's the catch? The catch is this. I'm not asking David how much he made last year. I'm asking David how much he thinks he's going to make this year. Or next year, I mean. David doesn't know what he's going to make next year. Next year hasn't happened yet. He says, well, I made $48,000 this year. I made $48,000 last year. Craig, I think I'm going to make $48,000. We go to the exchange and David picks a plan. So one of the big misconceptions about the healthcare reform law was the statement, my doctor doesn't take Obamacare. Everybody's heard that. I'm sure this room has definitely heard it. The misconception is there is no Obamacare. It's not care, it's a funding arrangement. So when David goes to the exchange, he's picking the same plans. Aetna, Cigna, Humana, United, Blue Cross. Same doctor's network, same plans for Craig that pays $1,285 a month. Mary pays 70 cents a month, and David pays $254 a month. Because it's not care, it's a funding arrangement. The carrier merely says, hey David, you paying all of it, you paying some of it, you paying none of it. So when people say, I don't want to go to healthcare.gov, I don't want my insurance controlled by the government, or I don't want Obamacare, the misconception they have is that the healthcare law controls plans on the exchange but doesn't control plans off the exchange, and that's actually not true. The healthcare law controls Every piece of insurance in the country, whether you buy something for yourself individually or you're working for a large employer, this healthcare law is dictating what those people can do everywhere in the country. It is an all-encompassing healthcare law. So David goes to the exchange, he picks Aetna, he mails his $254 check to Aetna, federal government mails a $1,000 check to Aetna, and life is good. At the end of the day, David sits down with the accountant, and the accountant says, well, how'd it go, David? Oh, it didn't go so good. I got laid off halfway through the year. I did make $48,000, only made $38,000. Oh, David, you shouldn't have paid $254 a month. You should have paid $154 a month. And David's going to get a $1,200 refund right on his tax return. By the same token, how'd it go, David? Went great. Got a promotion, got a raise, made $60,000. Oh, David, you shouldn't have paid $254 a month. You should have paid $354 a month. And David's going to owe $1,200 back right on his tax return. Now, I got asked the question, what is income? In my former life, prior to healthcare reform, I sold health insurance. And so we had conversations about pre-existing medical conditions and who you wanted to insure. Today, I have a tax conversation, and the health insurance is a byproduct. So I have to know things that are different than what you might know in your world. For instance, if I have an accountant in the room and the accountant says, well, I don't count Social Security income unless you're above X, that rule is not true for me. I have to count Social Security income even if it's below the point that you would owe federal income tax on it. I have to know the difference between Social Security disability and supplemental income, and whether you're getting alimony or you're getting child support or wherever your income is coming from. I actually have to know a fair amount of tax code to be able to look at you and honestly say, we are going to count this, we aren't going to count that, and here's what your income number is. We spend a lot of time with people trying to figure out the answer to the question, oh, I'm sorry, I'm pointing the wrong way. See, I don't even know what I'm doing. The answer to the question, what is income? Because I have to know a lot of rules that are different than even the rules you understand or the rules the accountants deal with on a normal basis. We also have to know who are you claiming on your tax return and all of those kinds of things. So, one more thing you need to know about David. David's really lucky. Because David's under 250% of federal poverty level, David qualifies for a second benefit called cost share. Cost share is going to lower his deductibles, lower his co-pays, lower his max out of pocket. To give you some perspective, I literally have clients that pay 70 cents a month with a $1 doctor's visit, zero copay, zero deductible, $500 max out of pocket. And max out of pockets today in this world on a compliant plan include everything. All doctor's visits, all prescriptions, all hospitalization, outpatient surgery, everything. They're paying 70 cents a month, and then the subsidies making up the rest of the premium. Some people aren't going to qualify for either a tax credit or their premiums are going to be high anyway. In a scenario like that, we've actually tried to partner with people. My job is to bring solutions, not to bring whatever somebody wants me to sell. So we actually work as independent agents. We write business with everybody. Aetna, Cigna, Humana, Blue Cross, United, you name it. We write business with all of them. One of the things we're doing this year is we're partnering with one of the health sharing ministries. And the health sharing ministries are kind of interesting because it's more like old school insurance. One of the problems with healthcare reform is the government not only tells you you have to own insurance, but you have to own the insurance that the government tells you you have to own. For instance, if Tom said to me, well, Craig, I want a plan with a $10,000 deductible, I would say, I'm sorry, Tom, you're not allowed to own a plan with a $10,000 deductible. The government won't let you have it. That plan's not compliant, and Tom's going to owe a penalty for not owning the right kind of insurance. If Giovanni said, well, I want a plan with a really low deductible, the government might say, I'm sorry, that's better than the plan you should have, and you're going to owe that Cadillac tax in a couple of years. You might have heard the phrase about the Cadillac tax. That's a penalty for owning insurance better than the government thinks it should be. So they defined a box and said, this is what the box is, and you have to own insurance that's inside the box. So when we try to do creative solutions, there's things you can do. There's plans like short-term medical plans that are not compliant, so they're much less money, but you still owe the penalty for not owning health insurance, even though you own health insurance. What we want to do is come up with compliant solutions and non-compliant solutions and tax credits and not tax credits to try to figure out how to solve your problem. So one of them is this Medishare plan. It's medically underwritten, so if you're reasonably healthy and you can agree to a Christian testament of faith, you're looking at premiums 50, 60% below market value. Huge, huge deal. I ran a quote on my family of 5, $600 a month for a plan with a $2,500 max out of pocket, if you want to put it that way. So huge, huge discounts, but you got to medically qualify and you have to agree to a pretty strong testament of faith. So we're trying to be a resource in the same way you're trying to be a resource to your clients to say, I'm not pigeonholed into doing any one thing. We're going to find the best solution for you. And you don't know the penalty, which is the kicker. All right, what happened to small businesses and what's the challenge there? When the healthcare law came along, one of the things it did was raise prices substantially. And I got really frustrated because people would have all these hyperbole talks, it sucks, it's great, it's this, it's that. And I always thought, I'm not going to do that, I'm just going to tell you what actually happened. And so what actually happened is rates literally doubled. I was sitting with a couple about 2 weeks before the healthcare law took effect. I said, we buy insurance today, it's $400. You buy it in 2 weeks, it's $900. Today, that plan would be $1,200. I mean, it's huge, huge rate increases on people. Well, the same thing happened in small businesses. Small businesses faced substantial premium rate increases due to mandates. For the government to stand there and say, hey, we're going to give you unlimited lifetime maximums, preventative care, all of these things done, covered at 100%. We're all business people in here, so we understand. I could look at Tom and go, hey, Tom, you should live in a 10,000 square foot house with maids and pool boys and yard people. You'd be so happy. And Tom would say, but I don't have the money to live in a 10,000 square foot house. Well, that's the same thing that's going on here is, as we add benefits, it just gets expensive. And so those benefits basically doubled premium for people. Only qualifying plans are available, so they've told us what plans we can write. This one is a big deal for business owners. These PCORI fees, it's $2 for every insured person in America. So if you own a business and you have health insurance and HSA or FSA plans, these $2 fees are due. If you have a fully insured plan like Aetna, Cigna, Humana, United, they're filling out the forms, they're paying the fees for you. But if you don't, and you're doing some kind of a self-funded plan, or you have your flexible spending accounts and things like that, you have to actually pay these fees. And they're due in the summer every year. So if you have a plan like that and you haven't heard anything about these PCORI fees, come talk to me afterwards and I'll explain what's going on. Loss of ability to class employees is a huge, huge deal. In the old days, business owners were trying to come up with solutions. And one of the things they may do is they say, well, we give the owner and the management a better plan than we give the employees. Or we pay 100% for owner and management, we pay 50% for the employees. What they're doing now is they're doing testing on your health insurance plan, very similar to like a 401k top-heavy testing. You guys might be familiar with that, where we're trying to figure out, are you giving more benefit to the owners and managers than you're giving to the employees? If your health plan fails that top-heavy testing, the penalty is $100 per day per employee for every day that employee was discriminated against. $36,500 a year per employee. You have 10 employees, we're having a $365,000 conversation. So as business owners, or as you talk to these people, we don't want to be discriminating in our benefits and giving a different benefit plan to the owners and managers than we're giving to the employees. Waiting periods for eligibility has changed. It says 90 days, and so many people got confused. They say, well, Craig, I have a 90-day waiting period. What they probably have is first of the month following 90 days. So if I hired Craig June 10th, July 10th, August 10th, September 10th, when did Craig's coverage start? October 1st. October 1st, that's actually illegal. I have to give him coverage by the 90th day, which would be August 10th. So most employers are changing that to the first of the month following 60 days. Summary of benefits of coverage. The healthcare law mandates that you give out what's called an SBC. It's printed front and back, 4 pages in this font with these examples on it. Again, huge mandates there. So if you're offering health insurance as an employer, you need to make sure you're giving out this SBC. Again, we're back to that $100 per day per employee fine for not giving them out. Education of employees on these new requirements is going to be super important. This is a little bit about why rates went up, and I won't spend a lot of time here, but I'll cover a couple of quick things for you. 3-to-1 age ratio. A lot of people ask, why did rates go up or what happened? One of the reasons is this 3-to-1 age band. In the old days, we worked off a 10-to-1 age ratio. Cheap guy was $1, expensive guy was $10. Well, the 3-to-1 age ratio means if the cheap guy was $1, the expensive guy could only be $3. It's not going to be $1 and $3. That's not how the world works. So it was $3 and $7, meaning young people got a big rate increase, older people got a little bit of a rate decrease or a stabilization based on your plan. The other thing is we used to have a male rate and a female rate. The healthcare law mandates unisex rating, so now we're in the middle. So males got a rate increase, females got a rate decrease or a stabilization. What that meant in your group was, if I had a group full of young males, huge rate increases as a result of healthcare reform. If I had a group full of females or I had a group full of older people, then I got a little bit of a rate decrease or a stabilization in the market as a result of these rules. Max out-of-pocket limitations. Of everything in the healthcare law, I have to admit that's the one thing I like. And the reason why is when somebody gives you a max out-of-pocket now, it is a max out-of-pocket and includes everything, all doctor's visits, all prescriptions, all hospitalization, deductibles, co-insurance, whatever. That's kind of nice just because I can say worst case scenario, here's my number. So that I think does, of everything, that's the one that makes it easy. The Cadillac tax is the penalty I was telling you would owe in the event that you had insurance better than the government said it should be. Insurers' fees and taxes, just for fun, let's talk about one of the I think there's two great truths in life, and so the first great truth in life is, do businesses pay taxes? So I'll actually ask a question. Do businesses pay taxes? Who said yes? All right, congratulations, sir. You're in charge of Coca-Cola. You might have heard the government's not fond of soda, so they're going to tax you $1 per can of soda for every can of soda that you sell. What are you going to do? By how much? So we just learned the first great truth in life. Businesses do not pay taxes. They merely collect taxes because the business has no money except the money it got from us. So when the president says Evil Corp doesn't pay its fair share, and we can fill in the blank there, Coca-Cola or Wall Street or the gas company or whoever, and we all say, yeah, what we're really saying is we would like to pay more taxes through Coca-Cola. I'd like to pay more taxes through my cell phone company, right? Because they don't have any money except the money they got from us. Why do I tell that story here? I tell that story here because pharmaceutical companies now owe $3.2 billion a year in penalties or fines just for the right to sell drugs in America. Health insurance carriers owe $16 billion a year in penalties or fines just for the right to sell health insurance in America. A lot of you guys are probably familiar with the medical device tax, the 2.3% excise tax on medical devices. When we were trying to figure this out, we were thinking medical devices were going to be things like walkers, canes, pacemakers. They actually defined it as anything a doctor touches in their office. My wife uses a makeup product from Rodin and Fields. You might have heard of it. It's kind of like a Mary Kay, and she has little rollers. She rolls stuff on her face. Is she going to shoot me for saying this? So anyway.
Don't tell her about the
Yeah, this isn't being recorded, is it? Can we edit that part out? Well, she finds out they're not selling the roller. And so because she's married to me, poor woman, she does some research and realizes that the federal government defined the roller that my wife's using in her bathroom as a medical device, and they're charging the excise tax, and the company was fighting it. So the reason why I bring that up is all of those fees have to be paid where? In the premium. Because none of those companies have any money except the money they got from us. Okay, that brings us to the question that he had, large employers. Let's talk about large employers. So large employers are employers with more than 51 FTEs, and FTE stands for full-time equivalent. What does that mean in English? Craig, I have a company, I have 40 full-time employees, and full-time is defined as anyone that works 30 hours a week or more. So I have 40 full-time employees, I have 20 part-time employees. Craig, I have no mandate. Well, maybe. What I have to do is take the part-time employees, add up all the hours of the part-time employees for the month, divide by 130, and that equals a full-time equivalent. So if I took those 20 people, I did the math, I come back and say that number's 12, 40 plus 12 is 52, full-time equivalents. I have a mandate to offer health insurance or pay a penalty. Once I've established that I have the mandate, I have one of three choices. The first choice is I'm mandated to offer coverage that's qualifying. You don't have to worry about that. Any plan you get today will be qualifying. And deemed affordable. What deemed affordable means is the employee pays 9.66% of the employee's income for employee-only coverage. What did he just say? Craig makes $20,000 a year. 9% of $20,000 is $1,800. $1,800 divided by 12 is about $160 a month. If this employer offers Craig coverage at less than $160 a month, then he met the mandate. He offered me coverage that was deemed affordable. And that employer does not owe any penalties or fines, regardless of whether I take the coverage or not. But Craig, I can't get a group plan unless 60 or 70% of my employees enroll. Actually, that's not true. Carriers are now mandated to write coverage regardless of the number of your employees that enroll. I have a 120-person group, we enrolled 30. I have a 60-person group, we enrolled 7. I have another 100-person group, we enrolled about 15 people. We can get it done, and for the employers, a lot of times, that's a cheaper option than the other two. So that $160 is very important because that's my first choice, is to offer deemed affordable. My second choice is to offer coverage, but it's not deemed affordable. Craig, you can buy health insurance, but it's going to be $170 a month. If the employer did that, I have the right to go to the exchange and get a tax credit. If I go to the exchange and get a tax credit, the employer owes a $3,240 a year penalty for every person that does. So 10 people went to the exchange, they got a tax credit. The employer in a year or so gets this bill for $32,000. He really has no way to fight it because he doesn't know whether I went to the exchange or didn't go to the exchange or how many people did or anything. So of all of my choices, that's the one I like the least because we can't qualify it. I can qualify offering coverage, and I can qualify the last one, which is, hey Craig, I don't care what the government says, I'm not offering health insurance. They can stick it. We'll do it that way. If the employer does not offer coverage, then they owe a penalty of $2,160 per employee per year for every full-time employee over 30 employees. Here's how this works. Craig has 100 full-time employees. He gets the first 30 for free. That equals 70. 70 times 2160 is $151,200. If Craig has a 100-person group and he doesn't offer health insurance, he owes a $151,000 penalty. After tax, not tax deductible. What are we talking about? $200 and something thousand worth of profit. Huge, massive penalties. Now, I just sat with a guy, and I'm going to answer your question now. So the question he had is, employers started getting creative. Craig, doesn't apply to me. I have Corporation A with 20 people, Corporation B with 20 people, Corporation C with 20 people. None of them are over 50. I don't have to worry about it. I'm sorry, it doesn't work that way. There's common ownership rules where I've got to stick all those together. You have 60 employees. We now have to meet the mandate. So I happened to sit with a guy that owns a couple of franchises in town, and we're doing the math on his employees, and he says, well, the first store's got 8 full-time employees and about 40 part-time people. The other store has about 3 full-time employees and about 40 part-time people. We didn't necessarily do the math, but we said, well, you're over 51 employees. You have a mandate to offer coverage or pay the penalty. I said, you're not going to offer coverage. And he looked at me kind of confused, and I said, well, let's talk about it. How many actual full-time people did he have? About 12. If he paid the penalty, he gets the first 30 full-time employees for free. He didn't have to offer the coverage because he wasn't going to owe the penalty. But he needed to understand the law and when he would have to offer coverage because his intention is to continue to open stores. He's got to be keeping a running total in his head of kind of how many full-time people do I actually have. So understanding the law and what your rules are in all these scenarios are really important. The one thing I want to implore of you, I am stunned at how many of these guys I still come across that are over 50 employees and they don't know they have a mandate. I have that guy. I have 2 more I'm writing right now that actually have to offer coverage and didn't know they had a mandate. How's this happening to them? It's happening to them one of three ways. Number one, other than me, have any of you heard anything about the large employer mandate in the last little bit? The last year or something. Almost nobody is talking about it. The press has said nothing. The president has said nothing. The news media says nothing, right? Nobody's talking about it, so the employers have forgotten. One of the problems with the healthcare law is things were just changing. This is thrown out, that's thrown in, whatever. The employers just think it got thrown out or whatever because nobody says anything to them. Number two, maybe they grew. They had less employees when it was talked about a couple of years ago. They didn't think about it, forgot about it, and now they've grown to over 50 employees and don't realize they have a mandate. Or number three, they're of the belief that because they have separate corporations, they don't have a mandate and nobody explained it to them. So honestly, and this isn't about Craig writing insurance, this is about you trying to help people that are going to be subject to massive, massive fines. $151,000 fine is put you out of business money. That's, I'm sorry, we don't operate anymore. We can't survive that. Think about the people that you know. I know Joe, he seems to have a lot of employees. Hey Joe, should you talk to Craig or somebody? If it's not me, I don't care who it is. I know this other guy seems to have a few franchises because I still come across them, I swear, every other week I find somebody that had no idea they had a mandate. And in the case of the guy I met with on Monday, hey, great. He didn't actually have to do anything, but at least he knows he didn't have to do anything instead of speculating. All right. So this is a little more about the large employers, but we won't cover that right now. What we're going to talk about is a couple of interesting things. So one of the interesting things about healthcare reform is it changed a lot of the rules in the world. And one of the rules it changed is the definition of compassion. In the old days, I offered David health insurance because I cared about David. And David would say, well, how much for me? David, it's $200 for you. What if I want to add my wife? It's $400 for my wife. What if I want to add my kids? Another $400 for my kids. And David says, no, wait, Craig. I saw your presentation. I can insure my whole family for $254 a month. I don't want your health insurance. I'm going to go to the exchange and do that. Except he can't. Just the fact that I offered David health insurance, then neither David nor his children are eligible to go to the exchange and get a tax credit. It's called the family glitch. Now I said neither David nor his children, but I didn't say anything about David's wife, Laura. Laura can go to the exchange. So Laura calls me up on the phone. She says, Craig, I want health insurance. Great, Laura. How many people in your family? 4. What's your total household income? $48,000. That puts you at 200%. 200% of federal poverty level. You pay 6.3% of your income. Laura, I can insure you for $255 a month. Now I'm insuring just Laura for $255 a month instead of the entire family because I offered David health insurance. Who thinks that's not fair? Well, what choices did the government have? I could have taken just Laura and Laura's income, and she says, hey, I make $15,000 a year, but would we want to insure Laura at $38 a month when her husband makes $150,000 a year? Well, no, we probably wouldn't want to do that. I could have taken just Laura and the total household income, but then she wouldn't have qualified for a tax credit at all, so we wouldn't have wanted to do that. So the government really had no choice other than to say, we're going to take the number of people in the household and the total household income. The reason why I say it changed the definition of compassion is because now the most compassionate thing I can do for David is terminate my health insurance. Target took a lot of heat a couple of summers ago for terminating health insurance on their part-time employees. What they couldn't say politically was they were terminating the coverage on the employees because they cared about them. It was the most compassionate thing they could do for the employees because then the employees were free to go to the exchange and get a tax credit and insure their whole family instead of doing it the other way. One other interesting thing about this is I do backwards math, I don't do forwards math. So in the old days we used to do forwards math, but I don't do that anymore. I do backwards math. So who can help me? Who's got a calculator? Let's have a little fun. Oh, I have a taker in the front row. All right, Laura calls me up on the phone, tells me she makes $40,000 a year. I say, great, Laura, you're going to pay 9.5% of your income. So we're going to go 40,000 times 0.095 divided by 12. $316 a month. So I can insure Laura for $316 a month. And Laura says, wait, I forgot about them 2 kids. Oh, now Laura's a family of 3 making $40,000. She's going to pay 6.3% of her income. 40,000 times 0.063 divided by 12. 063 divided by 12. I can insure Laura and the children for $210 a month because I do backwards math. I don't do forwards math anymore. More is less. If she then says she has a husband, and I won't make you do the math, if she then says she has a husband, oh, now she's a family of 4 making $40,000. I'll insure her, her husband, and her kids for $166 a month because I do backwards math, I don't do forwards math. Great question. So the question is the family of 4 only the people that I count on my tax return? A couple of unique things about healthcare law. If you come and get a tax credit, by law, you're mandated to file a joint return. Hey, Craig, I'm allowed to be married and file separate returns. Yes, you are, unless you get a tax credit. Remember, I don't work by the rules that you worked by before. I work by the rules that this law tells me I have to work by. So in this case, Tom would be required to file a joint return. I'm counting as dependents only the people that he claims on his tax return. Let's talk about how that works for people. Tom gets divorced, and this year he claims the kids, so he's a family of 3. But next year his ex-wife claims the kids, now he's a family of 1. Or Tom's supposed to claim the kids this year, so I run all the numbers for him. When he goes to file his tax return at the end of the year, the ex-wife ran out, filed the return first, and claimed the kids, and Tom owes huge amounts of money back to the federal government because they say, hey, you're not a family of 3, you're a family of 1. In tax law, you are what you are at the end of the year when you file your tax return. Let's talk about some really scary stuff. Had a guy that was like right in here, $60,000 in income. He gets a big tax credit, about $1,200 a month. This is last year. In December, he calls my partner David up and goes, hey, Dave, I need to take my wife off my plan. I just got divorced. Dave's like, what? Because I just got divorced. Oh my gosh. You are what you are at the end of the year when you file your return. Sir, your wife is single. She doesn't make enough money to get a tax credit. You owe that money back. You made $60,000. You're single. You make too much money to get a tax credit. You owe that money back. He owed about $12,000 back to the government because he got divorced in December and he owed all that tax credit back. Had a guy was looking at getting married. And so, she had a tax credit, he had a tax credit. And he goes, what happens if I get married, next month? Oh, your joint income will be over the $64,000. You'll owe your whole tax credit back. He was going to owe about $7,000 back if he got married because he owes the tax credit back. Lots of really scary stuff happens here. For financial planners in the world, a lot of us end up retiring right around this number. I can't tell you how many phone calls I get. I got Social Security, I got a little bit of a retirement benefit, and hey, I used to work at Lockheed Martin and they had me back to do some consulting. Great, sir. You're married, you're 60 years old, 60-something years old, you make $63,000 a year, you're going to pay about $300 a month for your health insurance, and the tax credit there is literally like $1,400. Huge, right? However, you break this line, you owe all that money back. Start doing $1,400 times 12. We're having, a $16,000 conversation that you owe back to the federal government if you break that $64,000 mark. But Craig, I want to work a little bit. I like to do it. Sir, they either need to pay you, if you do the math, you got to make about $90,000 just to be even with making about $63,000 by the time you pay the taxes, pay the tax credit back. Like, you'd be better off just volunteering to go in if you just want to do something because they can't pay you enough retired to make it worth your while. So we really spend a lot of time trying to help people understand the tax ramifications of this. I'll tell you what I'm probably going to do. I think it is time anyway. Yep, I'm right on time. So at this point, I'll stop and see if anybody has any questions.
Do these laws apply to people you contract?
1099 employees?
Yes.
So the question is, do the laws apply to 1099 employees? That's a great question. The answer to that would be no. So when I'm doing my count for 51 full-time equivalents or 51 full-time employees, I'm actually counting employees. So if he can have employees that truly meet the 1099 definition, and you better meet it, right, in terms of all the things that it says to be a 1099 employee. I don't set their hours. I don't tell them what to do. If you can truly meet that, they don't count in my numbers. The way the healthcare law works, and I forgot to mention this to you, is let's take small employers. For a small employer, you have one of two choices. You have the right to not offer health insurance. And if you don't offer any health insurance, you don't owe any penalties, you don't owe any fines, life goes on. If you choose to offer health insurance as an employer, then you're bound by all these rules that we talked about. As a large employer, if you're over 51 employees, full-time equivalents, then you have to deal with all that we just talked about. But 1099s is a legitimate out. Any other questions?
Good morning, Amy Noble, Compass Medical Realty. My question is, I receive group insurance through my husband's employer.
Okay.
I am a real estate broker, so I don't follow any of the rules, but I'm married to him. Can we receive a tax credit even though we're not in the exchange? I guess I'm trying to understand. Do large employees go into the exchange?
Right.
Because he works for Sanford, Burnham, Previs, so it's obviously a large employer. And say we make less on our net, but I don't know if it's our gross or our net, on our taxes, do we qualify for any money?
Okay, so a couple things happen here. For the moment, I'll assume you don't have any children, but if you did, you can just find yourself on the chart. Oh, family of 6. So I actually have numbers all the way out to 6. To give you perspective, family of 5 can earn under $112,000 a year and qualify for a tax credit. Family of 6 is probably something like $116,000 or $120,000 a year. However, a couple of things. Number one, pretty good chance that her husband's being offered deemed affordable coverage. I know that just because it's a large employer, and a large employer that's offering health insurance would be crazy to do otherwise, because we talked about the penalties for that, right? So we'll just assume that. Then, neither the husband nor the children have the right to go to the exchange and get a tax credit, but she does. Then it's just a matter of finding yourself on this chart and doing some math. So if you called me in the office, I could tell you exactly why you would or wouldn't do that. No, ma'am. It is household income. Yes, and she'd have to file a joint return.
So she wouldn't qualify? No.
I don't know if she qualifies or not. I don't know what her husband makes. So
Still file jointly, obviously
you'd have to file a joint return. So I got to say, well, in the real estate business, you made 30 and he makes 40 and they're at 70,000, family of 6, and I can do them, I can pretty much tell you from there. Yes, sir.
In your example where you got it down to 70 cents a month, I'm assuming it was either a silver or a bronze plan. Now, the problem is that they're still got to contend with the deductibles, which in the case of bronze is $6,000, which they've got to have $500 a month worth of expenses. They don't have any insurance.
Right, so his position is that I said 70 cents a month. I meant a bronze plan with a $6,000 deductible. It makes no sense for those people. That's a person that didn't talk to a qualified agent like myself or Mitch. And here's why. The 70 cent a month guy has better health insurance than any of you could buy with any amount of money out of your pocket. $1 for the doctor, $3 for the specialist, 0 deductible, $500 max out of pocket, prescription coverage like $1 for generics, $10 for brand name. There's no amount of money you can come to me with and buy a plan as rich as the 70 cent guy is getting because of that cost share benefit.
Just to give a solid example of what he just said, I just signed someone up that they had a choice of getting a zero premium, and a $6,000 deductible, or a $23 premium with no deductible.
Right.
And a $900 out of pocket rather than a $6,000 out of pocket. So for
Yeah.
$20, they actually have insurance.
Yeah, phenomenal insurance. I think we have a question in the back. And I have one more thing I want to cover for you guys, just kind of medical practice-wise.
Hi, Tina Phillips with Right at Home Home Care. I just want to clarify something. I guessed at the income this year because my husband is retired, so he gets Medicare and he gets Social Security.
Correct.
I guessed, and so I get a $200 subsidy on UnitedHealth Care and I pay $600 a month just myself.
Right.
So if I earn more than 60 together, if we earn, and I have to count his Social Security.
For this calculation you do, whereas your accountant may say it doesn't count in your adjusted gross income. For my calculation, it does count. Yes.
Well, does it count or doesn't it?
It counts for me.
What do you mean, me?
For this calculation.
Okay, because
his Social Security count.
I'm in the marketplace for just
Correct.
me.
So it does count.
So it does count. So
Yes.
if we go over $64,080
$1,000.
together, then I owe the 200 times 12.
Yes, that's correct. You owe $2,400 back to the federal government because you're rich. See, when the politicians say the rich should pay their fair share, this is the line of the people they think are rich.
Yeah.
That's who they define as rich. All right, I want to talk about the medical industry real quick and then see if that generates questions, because I forgot to do this for you, and that's really the point of me being here. What's happening in the marketplace? Massive devastations going on everywhere, right? UnitedHealthcare has decided not to write any individual health insurance anymore. Aetna, Coventry, Humana's pulled out of almost every county in the state and most of the counties in the country except for like 3 in our state. We're going to be left, Orange County's only going to have Blue Cross, other counties will have 1 or 2 carriers. And not only that, but part of what's happening in the world is carriers are trying to figure out a way to have lower cost. And the way they're having lower cost is to shrink the networks. So you're finding more and more plans with very narrow networks. The healthcare law has resulted really in a couple of things, but the main thing it resulted in is consolidation. You guys certainly would be familiar with how medical practices are consolidated. So your independent primary care physician can't be an independent physician anymore. He's had to join the big group, family physicians group or whoever. The same thing is happening with the hospitals. The same thing is happening with the insurance companies. The same thing is happening with the agents. And I'll bet the same thing's happening in your field as well. Because of compliance, penalties, fines, mandates, it's overwhelming to most of the people in the industry. So this year, for instance, most of the people that call me say, I want Florida Hospital. It's very important to them, whether it's important to you or not. There's only going to be a couple of plans you can get Florida Hospital, and you're going to have to be prepared to pay big money. As an example, no Florida Hospital, we're having, for some of these people, $20, $30 a month premium conversations. They say they want Florida Hospital. We're having $200, $300, $400 a month conversations. Like huge differences in the premium. That's really what's happening from our side is consolidation and much smaller networks. Skinny networks, as they call it. That's going to affect your medical practices because you may realize, but a health insurance plan can only have a doctor on the panel if the doctor has admitting privileges at the hospital. So if they cancel Florida Hospital, for instance, then all doctors that only have admitting privileges at Florida Hospital are automatically carved out of the network, and now we're left with just the ones with admitting privileges at the other ones, and then they're even paring that down. Some of what's happening there is carriers want to give better care. So some of them are doing some alliances with medical providers, and the idea behind the alliance is the medical provider is going to agree to give you better care, so to speak. I'm going to have more hours later into the evening. I'm going to have some Saturday hours. I'm going to agree to do more things with you when I meet with you. So the providers will agree to spend a little more time, do a little more stuff when they're with you, rather than that, out the door, keep you moving kind of mentality. So there's going to be big changes, as you know, EMR, ICD-10, and everything that's happening there. But along with everything that's happening with the providers in these skinnier networks and the mandate on your doctors to do more things. We want the doctor to have more hours. We want the doctor to be open on weekends. We're trying to keep people out of the emergency room. And it's even affecting how they're paid with the bundle payments, which I've heard us talk about, since I've been here, so I won't spend a ton of time, but this whole bundled payment mechanism and paying people for performance. And the medical industry is changing so much, all the way down to, I was at a conference this summer, and a lady was talking about a medical device she has that'll measure your glucose at the cellular level. So I'm a diabetic, it's measuring me at the cellular level. It's then going to send a notice to me and to someone else that says, your glucose is high. At that point, your phone beeps and says, hey, your glucose is high, drink a glass of water, go for a 10-minute walk. Oh, your glucose is low, drink a glass of orange juice and eat a muffin, or whatever it's going to tell you to do, because it's measuring you at this cellular level. The providers are now being asked to do a lot more of this kind of monitoring. So you might be familiar with the doctors are now calling patients. Hey, you need me to call you every day and remind you to test for your glucose level? I'll call you every day and I'll have a conversation with you about it. And that's all part of that patient-centered medical home and all the things that are happening there. So as you're familiar, there's massive changes sweeping through the industry, but this year, one of the main ones is going to be, on the individual side, the market is going to be super skinny. And it's going to put a lot of pressure on the doctors because there's a lot of people insured on individual plans in Florida.
When you say that the wallets are skinny, does that mean that when you say that the groups
Networks.
are skinny, the networks are skinny, does that mean that there's fewer doctors and fewer choices?
Absolutely. Okay. So both. What it's going to mean is, in Orlando, for instance, in Orange County, individual plans, Blue Cross is the only thing on the exchange. The bottom chunk of plans is My Blue Network, and the My Blue Network is a skinnier network. So a lot less doctors on the plan, period. No Florida hospital. And so that might be a huge chunk of it. The next thing that comes is Blue Select. Blue Select, no Florida hospital, thinner list of doctors. Instead of 1,000, I've got 500, or however those numbers work out. And then I got to get all the way up to Blue Options if you want to go to Florida hospital.
So that means that the doctors who are on those skinny plans are agreeing to take less payment for the services that they provide, and that's why they're included in those networks?
I can't answer that question for sure. Here's what carriers were trying to do. People always believe that the insurance company wanted you to go to the cheapest doctor they could get a contract with. So Giovanni says, hey, I'll see your patients for $5. And Mitch says, well, I'll see your patients, but it's going to be $50. Everybody always thought the insurance company only wanted you to go to Giovanni. But it depends. Because if Giovanni, I go to see Giovanni and he says, well, let's try this blood test, let's do a sling, let's do an x-ray, let's do an MRI, let's do this, that, and the other thing, and eventually he says, well, you're going to need open heart surgery. That's much more expensive than if I went to Mitch and Mitch gave me the correct diagnosis and the correct treatment the quickest. So they've been trying to evaluate providers based on quality and efficiency, diagnosis and treatment, probably more so than what they're necessarily paying the doctor in terms of a fee for your visit. So in theory, they're trying to apply quality and efficiency standards to the network and then combine that with, hey, I want you to also give me these other things. I need some additional hours, even if it's with a PA in your office. I need some Saturdays because I don't want Craig going to the emergency room for the flu. I want him to be able to come to your office. I need some same-day appointments. I need some other things. The problem here is carriers get caught. So Blue Cross could have looked last year and said, hey, in Orange County, we had 50 plans. We need 5 doctors. Life's going to be good. They set 5 doctors up for 2017, not realizing that Humana was going to pull out, Aetna was going to pull out, United was going to pull out, Coventry was going to pull out, and they're not going to have 50 plans anymore. They're going to have the entire Orange County market of individual plans because there isn't anywhere else to go. And the 5 doctors they contracted isn't going to get it done, and that's going to create long lines, waiting, can't get in, can't see a doctor. And part of that gets blamed on the doctor, part of it gets blamed on the carrier, but in reality, it's probably not necessarily either one's fault. How does Blue Cross know that Aetna, United, Cigna, Humana, everybody's going to leave the market? They don't know. And so they made plans based on what they did last year or what they thought the market was going to do. There'll be mass chaos, huge amounts of problems.
What a ray of sunshine.
Well,
No, it's the truth. It's
I
the
get
truth.
accused,
Yeah, it's
in
the
all
truth.
honesty, I get accused of being inflammatory. And I always tell people, I'm not inflammatory. My job is to tell you what's actually happening. You can decide whether you think that's great or you think it's not great. That's not my position. We do write insurance, and I never even said this, but we do write insurance. So we write Medicare plans, individual plans, all the way up through large employer plans. So if you know somebody needs some help, we'd be happy to help them.
Now, thank you very much for a lot of great information. It's just unfortunate that the subject matter is what it
that's right.
is, but thank you very much. Round of applause for Craig.
Have a great day.